You never hear about the boring ones until they're worth $500 million. That's the thing nobody tells you at the start. The holding company doesn't look like anything when it's being built. There's no launch event, no press release, no moment where someone hands you a plaque that says you've arrived. Ellery never mentioned his to you directly, but the broker did, the same one who told you about the Gulf Stream. 3 businesses: an HVAC company in the Midwest, a small software company that invoiced dental practices, and a commercial cleaning operation with contracts in 4 office parks. None of them had a logo you'd recognize. None of them had a founder story anyone would optionize for a podcast. But together, every single month, they threw off cash the way a well-maintained engine throws off heat. Quietly, reliably, without asking for attention. That's the entire premise. A holding company is not a startup. It is not a brand. It is not a vision deck with a mission statement about disrupting an industry. It is a structure that owns other businesses and allocates the capital those businesses generate into more businesses, compounding the whole thing forward until the math gets genuinely hard to look at without blinking. The core promise is simple enough to write on a napkin. Buy businesses that produce predictable cash. Use that cash to buy more businesses. Repeat until the portfolio is large enough to refinance, recapitalize, or sell at a multiple that would make your earlier self sit down for a minute. The reason most people never build one isn't that they lack the intelligence. It's that they reach for the wrong first asset. Level 0 is the engine question. Before you touch a deal, before you write a letter of intent, before you spend a single dollar on a quality of earnings report, you need one business that does one thing consistently. Throws off cash. Not hype, not potential, not user growth, and a plan to monetize later. Cash. Predictable, boring, recurring cash. The businesses that tend to do this reliably share a few traits. Service businesses with repeat contracts. Landscaping companies, HVAC, pest control, commercial cleaning, anything that gets paid monthly or seasonally to maintain something people can't ignore. Niche software with annual subscriptions and customers who would rather keep paying than switch. Small commerce operations in categories unglamorous enough that nobody's trying to disrupt them. Nobody's raising venture capital to revolutionize pool chemical distribution. That's the point. The businesses worth starting at level 0 are the ones that look too boring to attract competition smart enough to hurt you. But before you buy anything, you need a buy box. Think of it as your rules of engagement. A written, non-negotiable document that tells you what you will look at and, more importantly, what you will not. Without it, you will waste 6 months doing diligence on deals that were never right for you because hope dressed them up and you wanted to believe. Your buy box at level 1 should look something like this. Industry with low customer concentration, meaning no single client should represent more than 20% of revenue because the day that client leaves, your cash flow doesn't dip, it collapses. EBITDA margins north of 15%, so there's actual oxygen in the business after expenses. Deal size you can actually access, somewhere between $500,000 and $2 million in purchase price at the early stage before you've built the borrowing power to go bigger. A business that can be run by an existing operator because you are not buying yourself a job. You are buying a cash-producing asset that functions whether or not you're standing in front of it. Then there's the question everyone skips over because they're embarrassed to admit they haven't solved it yet. How do you build credibility before you have capital? The answer is that credibility at level 1 is not money. It's evidence of judgment. You can build an advisory bench of people who've operated or exited businesses in your target industry. You can structure a search fund or a small deal with an operator partner who runs the business in exchange for equity and salary while you handle the capital raise and the structure. You can do a consulting engagement with a small business owner who's thinking about succession and prove that your ideas about operations actually work before you ask anyone to stake you. You're building a track record made of proof instead of promises. That track record is the substitute for the balance sheet you don't have yet. None of it works, though, without the baseline financial literacy that most people think they have and don't. There is a specific trap waiting for you at level 1 called working capital, and it will catch you off guard the first time if you haven't been told to look for it. EBITDA is not cash. You will look at a business with $400,000 in EBITDA and feel excited, and then you will look at the cash flow statement and realize the business collects payment 60 days after it invoices and pays its suppliers in 30, which means it is constantly eating its own cash just to operate. The business is profitable on paper and starving in practice. You need to understand the difference between what a business earns and what it actually produces in liquidity, because at level 1, running out of cash is not a setback. It's the end. The last thing you set up before level 2 becomes an option is what you might call an operating system. A monthly reporting cadence, a KPI dashboard covering revenue, gross margin, customer count, churn, and cash on hand, and a simple decision rule for every dollar the business generates. A portion reinvested in the business, a portion reserved for the next acquisition. A portion held as a liquidity buffer you don't touch unless something breaks. 3 buckets every month. Without that structure, profit becomes lifestyle before it becomes leverage, and you spend years working in the business instead of building above it. That's the whole game at level 1. It doesn't look like anything worth filming. That's exactly why it works. The first acquisition is the one that teaches you everything the books got wrong. Not because the books are lying, because the books describe the process and the process is not the problem. The problem is the version of yourself sitting across the table from a seller who built something over 23 years and needs to believe you are the right person to carry it forward. And you have to hold your face together while internally you are doing arithmetic you've never had to do with stakes this real. That's the part they leave out of the case studies. But let's back up to before the table. Because most people who never close a deal don't fail in the room. They fail before they ever find the right room to sit in. Deal sourcing at scale is not a spreadsheet you update when you feel motivated. It's a system you run every single week whether you feel like it or not. There are 2 channels worth building early. The first is proprietary outreach, which means you are reaching business owners directly before they've called a broker, before they've listed, before the deal has attracted the kind of competition that inflates price and degrades structure. You are sending letters, real letters sometimes, targeted, researched, not a mail merge. You know the owner's name. You know how long the business has been operating. You know the industry and you say something specific about why you're interested in it. You are not pitching. You are opening a conversation. The close rate is low. The quality of what you find is not. The second channel is brokers, but you have to understand what brokers actually are before you use them correctly. A broker's job is to get the seller the best outcome, not yours. That means if you want good deal flow from brokers, you need to be the buyer who closes. Fast, clean, with minimal retrading after diligence. Brokers talk to each other. A reputation for being difficult, slow, or unreliable will dry up your access inside of a year. A reputation for being decisive and credible will put you on the short list before the listing ever goes wide. Your buy box, the one you built at level 1, is what lets you filter fast. When a deal crosses your desk, you're not spending 3 weeks deciding if it fits. You know in 48 hours or you pass? Indecision is expensive and brokers remember it. Now you're in the room. You have a business you want to buy. Here's where people discover that price is almost never the whole conversation. Valuation starts with multiples. Most small to medium businesses trade somewhere between 3 and 7 times EBITDA depending on industry, customer concentration, growth trajectory, and how badly the seller wants out. But the number on the term sheet is not the deal. The structure of how you pay that number is the deal. A seller note is your best friend at level 2. It means the seller is financing part of the purchase price themselves, paid out over time from the cash the business generates. That aligns their interest in your success and preserves your capital for operations. An earnout ties a portion of what you pay to future performance milestones, which is useful when the seller believes the business will grow and you want to hedge against a story that doesn't materialize. Rollover equity means the seller keeps a small stake in the company post-close, which tells you 2 things immediately. They believe in the upside, and they're willing to stay close enough to the business that the transition doesn't detonate. Structure can beat price. A lower headline number with a favorable seller note and a working earnout can be worth more to you than a clean all-cash deal at a higher multiple that drains your liquidity on day 1. Due diligence is where the deal either confirms or falls apart, and the single most important thing you are doing is adjusting EBITDA for what's real versus what's presented. This is called quality of earnings, and you want a professional doing it before you close anything meaningful. You are looking for owner add-backs that aren't legitimate. You are looking for revenue that's concentrated in one customer who could walk. You are looking at customer retention over 3 to 5 years because a business with 90% annual retention is a fundamentally different asset than one with 60%, even if the revenue looks identical on a single year's P&L. You are checking for deferred maintenance, aging equipment, HR liabilities, and tax exposure the seller hasn't mentioned yet. You're reading contracts, not summaries of contracts. This is not paranoia. This is the price of not getting surprised 18 months after close by a liability that was always there. Just quiet. Financing the deal means understanding your stack. Equity is the most expensive capital because it costs you ownership. Debt is cheaper, but it creates obligations. The ratio between them determines your debt service coverage ratio, which is the measure of whether the business earns enough to pay back what you borrowed with enough cushion left over that a bad quarter doesn't put you in default. Covenants and lending agreements are the rules your lender will hold you to, and you need to understand every single one before you sign, because violating a covenant even on a technically profitable business can trigger an acceleration clause that ends the whole thing. Mezzanine financing sits between debt and equity in the capital structure and comes with higher cost but more flexibility. It's worth knowing it exists before you need it. You close. Now the first 90 days are the only thing that matters. Keep what works. Don't reorganize, rebrand, or restructure before you understand why something was built the way it was. Most things that look inefficient from the outside were built around a constraint you don't know about yet. Your job in the first 90 days is to stabilize cash, retain the key people who make the business function, and listen more than you change. Talent is the one thing you cannot recover once it walks out. The operator who's been there 12 years and knows every client by name is not replaceable with a job posting. Set governance early. Clear accountability, monthly reporting, and an incentive structure that makes your operator's success inseparable from the business's success. Eliminate founder dependency, meaning if the previous owner was the entire reason customers stayed, that's a risk you need to systematically reduce over the first year by building relationships at multiple levels of the organization. And then there's the capital allocation question, which becomes the central question of your entire operation from this point forward. Every dollar the portfolio generates has to go somewhere. You're deciding constantly between buying another business, building capability inside an existing one, paying down debt to reduce risk, or holding cash, because the next deal isn't worth the price the market is currently asking. The discipline is in saying no when no is correct. Most holding companies that blow up don't blow up because they couldn't find deals. They blow up because they couldn't stop doing them. That's the difference between a portfolio and a pile. One of them is a machine. The other is just expensive exposure. So you have the portfolio, 2 businesses, maybe 3. Cash flowing, debt servicing, operators in place. And for a moment it almost feels like you've arrived somewhere. You haven't. You've just reached the part where most people stop building and start administering. And those are not the same thing. The difference between a portfolio and a machine is architecture. A portfolio is a collection of assets that happen to share an owner. A machine is a system where each part makes the others more valuable. Getting from one to the other is the work of level 3, and it starts with a decision most people avoid making because making it means closing doors. You have to choose a vertical, not because you can't own businesses across different industries. You can. But the holding companies that compound fastest pick a lane and go deep before they go wide. Home services, industrial distribution, healthcare services, business-to-business software. Whatever it is, you're going to build your next acquisitions around a core thesis, and that thesis is what transforms your deal activity from random accumulation into what people in the space call a platform play. You buy the anchor, then you tuck in smaller businesses that extend your geography, add capabilities you don't have, or bring in customer segments you haven't touched yet. Each tuck-in costs less than a standalone acquisition at the same size because it's stepping into infrastructure that already exists. That's the compounding mechanic. Not financial compounding, structural compounding. But structure without discipline just gives you a bigger mess to manage. So the second thing you have to build is shared services, and you have to do it without creating the bureaucracy that kills the operating culture inside your businesses. Finance, HR, procurement, IT, and marketing cannot be reinvented at every entity in the portfolio. They become a shared internal function, an overhead layer that earns its cost by driving down expense and up capability across the whole group simultaneously. One insurance broker negotiating for 6 companies. One payroll platform. One accounts payable cycle. It sounds administrative because it is. It's also where real margin lives once you're at scale. The businesses you own should feel like they're operating with resources they couldn't afford independently. That's the value factory. If your shared services feel like corporate interference instead, you've built it wrong. Now the synergies. This is the word everyone uses and almost nobody measures. Real synergies show up in 4 places. Cross-selling between businesses that serve overlapping customers. Purchasing power when you consolidate vendor spend across entities. Pricing discipline when your brand and scale give you leverage a standalone operator doesn't have. And churn reduction when a customer who loses confidence in one service can be retained through a relationship with another. None of those are automatic. Every single one of them has to be tracked against a baseline, or you're just telling yourself a story about value creation that may or may not be real. The talent architecture is what determines whether any of this survives contact with the future. You need a bench. Operators who can step into a new acquisition or a troubled asset and run it while you source the next one. You need playbooks, written institutional memory about how you integrate acquisitions, how you run reporting, how you handle underperformance. You need succession planning at every layer because key person risk doesn't disappear when you're the one who hired all the people. And your incentive structure has to reward long-term value creation, not quarterly performance. Equity participation, profit sharing tied to multi-year outcomes, something that makes your best operators think like owners because the day they stop thinking like owners is the day they start thinking about leaving. Risk management stops being optional the moment you have real leverage in the system. You set concentration limits so no single business represents more than a certain percentage of total portfolio EBITDA. You set leverage limits so a downturn in one asset can't cascade into a covenant violation that threatens the rest. You hold cash reserves, not because you're afraid of opportunity, but because the holding company that survives a recession is the one that bought assets from the ones that didn't. You run scenario planning quarterly, not because you can predict the scenarios, but because the exercise forces you to see the dependencies you've stopped noticing. Your reporting has to evolve to match the complexity. Segment-level KPIs, unit economics by business, not blended. Leading indicators that tell you something is wrong before the monthly P&L confirms it. Customer retention trending down 6 months before revenue follows. Days sales outstanding creeping up before cash gets tight. The numbers that trail are for reporting. The numbers that lead are for decision-making. And then there's the one that most operators underestimate. Reputation. Lenders compare notes. Sellers talk to other sellers. Partners remember how you behaved when things got hard. The holding company that closes reliably, communicates clearly, and doesn't retrade deals acquires a cost of capital advantage over time that compounds just as surely as the financial architecture does. Reliability is not a soft skill at this level. It is a structural asset. The machine doesn't run because you're working harder. It runs because you built it to run. The machine runs. And at some point, the machine becomes worth something that stops feeling like a number and starts feeling like a different kind of problem. 500 million is not a finish line. It's a threshold. The moment your holding company crosses into institutional territory, the rules that got you here stop being sufficient, and the people across the table from you are no longer the regional lenders and local sellers who thought you were slightly crazy for doing this in the first place. They're sovereign wealth funds, family offices with more assets under management than the GDP of a small country, and PE shops that have seen 100 versions of what you've built and know exactly which screws to turn to find out if it holds. So let's talk about what actually drives the valuation, because the number on the page isn't arbitrary. Scale matters, but it's not the whole story. What the buyer or the capital partner is really pricing is the durability of the cash flows, the trajectory of the growth rate, the margin profile, and the multiple expansion logic. That last one is where most founders leave the most money on the table. A business doing $10 million in EBITDA in a fragmented, unsexy industry might trade at 6 times. A platform with $40 million in EBITDA in the same industry with proven integration capability, shared infrastructure, and defensible market position trades at 10 or 12 times. The cash flow didn't change. The story around it did. Multiple expansion is not accounting magic. It's what happens when your business stops looking like a collection of companies and starts looking like an institution. To get there, the capital stack has to be clean. That means refinancing opportunistically as your credit profile improves, not sitting in expensive debt because it's familiar. It means laddering your maturities so you're never caught with 3 loans coming due in the same 12-month window when rates are high or lenders are nervous. It means covenant management as a proactive discipline, not a quarterly scramble. And it means preserving optionality. The holding company that is locked into a single lender relationship with tight covenants and no room to move cannot pursue the acquisition that appears at the wrong moment in the credit cycle. The one that kept its balance sheet flexible can. Governance is where most founder-operators resist the hardest and pay for it the longest. Boards, independent audits, formal controls, written policies for things you used to decide over the phone. It feels like friction. It is friction. It's also the thing that unlocks better capital at lower costs from the kind of partners who do real diligence. Institutional-grade operations signal institutional-grade risk management. The LP or strategic partner who passes on your deal because your reporting is informal and your board is 3 people who all text in the same group chat is not being difficult. They're reading the room correctly. Portfolio pruning is the discipline that almost nobody talks about because building feels like progress and selling feels like retreat. It isn't. The zombie project that's been limping along for 18 months because you don't want to admit it was a mistake is consuming management attention, capital, and emotional bandwidth that belongs somewhere else. The non-core asset that's cash flowing fine but doesn't fit the thesis anymore is worth more to someone else than it is to you sitting inside a platform it doesn't strengthen. Prune it. Take the capital and put it into the highest ROIC move available to you. That's not cutting losses, that's allocating like a professional. When liquidity becomes a real conversation, there are exactly 4 paths, and each of them has a different clock and a different cost. A minority recapitalization gets you cash and a valuation event without giving up control, but it brings a partner into the room permanently. A strategic sale maximizes the number but ends the game. An IPO opens the capital markets but puts you in a quarterly performance theater that has nothing to do with how you've been operating. And the permanent holdco structure, never selling, just compounding, is only available to you if your cash flows are strong enough that you don't need the exit to prove anything. The right answer depends on what you actually want from the next decade of your life, not what sounds impressive to say out loud. That's the founder mindset question that determines everything else. The holding company built to satisfy an ego will add one more acquisition when it should prune, hold on 12 months too long, and negotiate against its own interests because letting go feels like losing. The allocator who stuck to the buy box, protected the downside, and never confused the size of the portfolio with the quality of the returns will know exactly when the timing is right and exactly what the number has to be. Cash engine first, disciplined acquisition second. Platform compounding third, institutional scale fourth. That's the playbook, all 4 levels of it, and the only real question is where you are right now. Drop it in the comments. And if you're building something, subscribe, because the next level always has mechanics the current one can't see yet.